financial markets in turmoil.
What are the root causes of the financial crisis?
The dollar losing value.
Heading for its biggest loss in nearly 3 decades.
Will Social Security even be there?
I don't know.
Buy or rent?
That's a very good question.
Interest rates.
I'm not so sure.
Where do you put your money?
I don't know.
Welcome to the show that answers your questions. This is Follow the Money Weekly with your host, economist, and best-selling author. Here's Jerry Robinson.
Friends, welcome to this week's edition of Follow the Money Weekly. So glad that you're joining us all around the world. FTMdaily.com is our website. That's FTM, like followthemoneydaily.com. So glad to have you this week. Well, we have an interesting show. Of course, we're always joined by our good friend Tom Cloud. He'll be here with an update on precious metals, and we'll also be joined by Tommy Cloud Jr. He'll be here with a investing insight for you. Just a brief minute. Well, let's just dive right in. We're going to start by talking about what's been happening in China. Chinese growth, economic growth, slowed to 7.4% in 2014. This, of course, was causing quite a bit of havoc in the Shanghai market on Monday. Shanghai shares slid by 7.7%, the worst drop in over 6 years. We haven't seen this kind of sell-off in China since the 2008 crash. So you can really feel it right now. You can feel the market getting very tipsy, especially now as we see oil just diving. We see gold beginning to perk up, which I told you recently is a good sign. It really is. It's a good sign to see gold perking up amidst this turmoil that we're seeing in the global economy. The 7.4% growth explained by China would seem as if it would be the envy of most economies. I mean, many economies around the world would love to have the problem of just clocking in only 7.4% annual growth. But for China, it's a different story. Beijing really is calculating all of its growth based upon a certain figure. It needs this much growth economically just to create enough jobs for the growing and huge already, but also growing population within all of the major cities in China. Right now, the equivalent of the entire country of Japan, the population of Japan, is moving from the rural areas to the cities in China each and every 8 years. Let me say that again. The entire population of Japan, that number, is the same amount of people who are moving from the rural villages of China into the cities every 8 years. And to create enough jobs for these individuals, you have to have a certain level of economic growth. Chinese stocks also fell on the fact that the IMF, who is usually a fairly bullish institution, downgraded its outlook not just for China, but for several other large economies. But it downgraded China's economic growth figures in the year 2015, its forecast down to 6.8%. So we're continuing to see some problems develop in China right now. The stocks are buoying back this week, but we need to keep our eyes on China. But there really is no doubt about it. Everywhere you look, the world economy is in trouble. The Eurozone, of course, is at risk of its third recession in 6 years. The Japanese economy, after all of these Abenomics we've heard about, are not fixing the problem. It's still a wreck. And even here in the United States, we continue to hear about how great the economy is, and some people are beginning to believe it. But the truth is that when you look at the actual numbers, you see that wages are still stagnant, and the number of jobs that we have gained are not the same high-quality jobs that we have had in the past. Nevertheless, the Fed is remaining on track, according to the latest reports, to raise short-term interest rates later this year, even though long-term interest rates here in America are falling. And as the ECB, the European Central Bank, prepares to launch its own stimulus program, which we'll talk about in just a moment. But here in the United States, the Fed has held short-term interest rates near zero since December of 2008. That's a very long time. And we mustn't fail to realize how significant that really is. Imagine, if you will, for a moment, a man who has just had a massive heart attack. He's taken down to the hospital. He's in the ER, and the doctors and the nurses have him surrounded with a defibrillator, which is an electronic device that gives an electric shock to the heart. And they are just pumping him over and over again, trying to get him to revive. And this is exactly what the Fed has done to the U.S. economy. They reacted very unusually by dropping rates to near zero and then leaving them there for many, many years, pumping in tons of liquidity. And in reality, they have solved nothing. They have solved nothing. When you really think about it, sure, they cause stock markets to rise, but you cannot print more money and then create more jobs from that. The structural economy that we have here in America, the structural basis of our economy, is still in trouble. No amount of money printing can solve that, and that's exactly what Japan has learned. Despite their tremendous amount of money they've pumped into their economy. That's what the ECB is going to learn whenever they begin to pump money into their economy. But don't miss this, because in essence, what the Fed has done has been Herculean intervention into the economy. And if we have any kind of good numbers that are coming out, you have to think to yourself, what else did we expect? I mean, we had a dead man on the gurney practically, and the Fed was trying to revive him with money printing and with zero interest rates. It's amazing that all of the hard intervention that has been put into this economy by the Fed has not resulted in more growth. If they were so correct that this was going to lead to growth, we should see more growth now. But instead, we see a tepid growth that, again, is not sustainable because it is based upon the wrong kind of prescription, namely money printing and low interest rates. Well, at their next meeting on January 27th and 28th, Fed officials are probably going to make mention again about their plans to increase rates. Many economists don't expect the rate increase to come until sometime after June, maybe at the June meeting, maybe after. And this is really all playing out as we had expected. Back in 2007, I wrote a book, Bankruptcy of Our Nation. And of course, it's been revised and expanded since then. But when I first wrote the manuscript, I had written in it that a crash was coming. That crash was going to be followed by a massive sucker rally. And that sucker rally was going to be followed by an even worse crash. And that worse crash was going to be so bad, in fact, that we would never fully recover back to the same level. And I believe that's what we see playing out here. We've already seen the crash. That, of course, came back in 2008. The sucker rally began after the Fed intervened and began pumping money in and lowering interest rates. And this sucker rally has been very lucrative for people who have had money in the market. Many people jumped out of the market back in 2008. They sold at the bottom. Many of them are, still not in the market, or many of them are just now getting back into the market. But I believe that we are on the final stretch of a massive sucker rally that cannot last, and it's going to result in a crash. And this crash that we're going to see, I believe, is going to make 2008 look a lot tamer than any of us can realize. And the reason is because we've gone so high. This is the part that I think most people miss about economics and money itself, is that when you pump money into the economy, it has to go somewhere. And when that money comes back out, it causes a reduction in asset prices. And so the Fed can't pump all the money in and leave it there. It has to begin draining the money out. Otherwise, you're going to have tremendous inflation. And many people wonder where the inflation is today. They say, look at all this money that got pumped into the economy. Where's the inflation? Well, the majority of people see the inflation. I mean, they see it when they go to the grocery store. They see it when they go down and they pay their electric bill. They see it. They're seeing the inflation. But inflation is not the most insidious form of destruction of your economy. Deflation is. And that's exactly what Europe is facing. Europe is facing a period right now of deflation. They're worried about deflation. And this is what's driving their central bank to talk about creating a brand new bond buying campaign. Before we talk about the ECB campaign, I want to talk about Greece, because on January 25th, which is this Sunday, the Greek people will be going to the polls to vote in national elections. Back in December, Greek lawmakers failed to agree on appointing a new president. They had 3 attempts, and they failed to do it on every single occasion. So now, because of that, because they failed, the Constitution had a simple trigger in it that said, okay, well, if the lawmakers cannot decide upon a new president in the parliament, then it's going to have to go to the people. And so it triggered this national election that is going to be held on January 25th, this Sunday. And whoever is elected will have the awesome power to decide whether Greece will continue with its current austerity measures. Right now, the Syriza party is leading, and they are a far left-wing radical party that has promised to tear up the bailout reforms, provided to them by the Troika and by the ECB and by the EU, this whole group that has been gathered together to oversee and steward Greece's finances. Now, the New Democracy Party is kind of squeezing up on Syriza. It looks like they might actually maybe in the lead later this week. We'll have to kind of pay attention to what happens in Greece. But I tell you this, if the Syriza party wins and they are able to put together a coalition, it's very possible that they will reject the austerity reforms that have so damaged the Greek economy, and it will result in a default, which could lead to Greece being booted out of the Eurozone. And this, of course, would cause Greece to have to stop using the euro currency and readopt its old currency, the old national currency, the drachma. So there's great tension right now in Greece and in Europe, in Germany, in the halls of power, because they're worried about whether this whole euro experiment is going to go down the tubes just because of Greece. Now, I don't believe that. I don't believe that we're going to see the eurozone go down just because of Greece. But this is going to be an important touchstone to Europe and to the whole European Union experiment. So the election is going to be held on Sunday in Greece, but on Thursday of this week, we could see the announcement of a new major bond buying program by the European Central Bank. They're blaming the deflationary pressures for the need to begin pumping in massive amounts of liquidity, just like the Fed did here in the United States, into their own economy. We got a few signals that this QE announcement is going to be fairly sizable by the fact of what we saw with the Swiss National Bank, cutting the cap that it had on its currency. For a period of time, the Swiss had put a cap on its currency, linking it to the euro. They got rid of that last week, shocked the markets, causing the euro to fall by 30% against the Swiss franc at one point. And then earlier this week, we also saw Denmark's central bank surprise the markets by announcing a new interest rate cut. All we really have to do is look back and see how these bond buying programs have impacted previous economies. Of course, here in the United States, the Fed took on a Herculean type of bond buying program, and of course it led to lower bond yields, sharp increase in stock prices, and a depreciating currency. We can look at Japan and see pretty much the same thing when they launched their own version of QE. It was about $1.4 trillion they pumped into their economy, the equivalent of $1.4 trillion. And it caused Japanese bond yields to fall. It caused Japanese stocks to pop. And it led to a depreciation of the yen, almost by 25% against the U.S. dollar. Now, looking back at Europe, right now, bond yields are negative, so we already have that kind of baked into the cake as investors expect this to happen. So we already see lower bond yields. So the euro is also at a 9-year low against the dollar, but it could still fall much further. But the outlier is euro stocks. European stocks are lower than one would expect on the eve of such a major monetary stimulus move. That's why I'm beginning to take some positions in European stocks. Of course, we've held European stocks for some time, but now we are doubling up in anticipation of this major move by the ECB. All right, and one final note before we bring on Tom Cloud. Tonight is the State of the Union Address, the 2015 State of the Union Address by President Barack Obama. He's set to outline a plan for tax increases. That's no surprise. Higher government spending, of course, that is no surprise. And we're expecting him to talk about a few things. Number one, we expect to hear him talk about how the economy has improved so greatly under his watch. Of course, he'll probably won't mention the fact that the national debt has increased by $7.5 trillion underneath his watch. He'll probably conveniently leave that out. He'll probably also conveniently leave out the fact that more people are now on food stamps than ever before in our nation's history. He's going to probably leave that out as well. We also expect him to talk, or at least spend some time, on America's cybersecurity challenges. America is really not ready for what I believe is coming to it in the form of cyber warfare. We're already beginning to see that now with many of the different things that we've seen. Sony, of course, is just one example. Bank of America. We've seen lots of different instances of cyber threats to the U.S. economy and to the U.S. infrastructure. And maybe it has something to do with the most popular passwords in 2014. I can't believe I found this list. The most popular passwords of 2014. I'll give you the top 3. There were like 10. Let me give you the top 3. Number 3, okay, these are real passwords. These are the most popular passwords in America in 2014, okay? Number 3 is 12345. That is the third most popular password in the United States, okay? Number 2 is password. All right, that's just absurd. And then number 1 is, drumroll please, 1, 2, 3, 4, 5, 6. All right, so that might explain some of the cybersecurity threats that we have going on in our economy right now. So crazy stuff. We also expect Obama to talk about his new plan for free college for Americans. This is something that came out of Tennessee. Republicans actually were the ones who spearheaded this in Tennessee, and Obama is going to try to nationalize this concept. He's going to try to nationalize this idea where high school students, when they come out of high school, in essence, once high school students graduate, they will then be able to have the first 2 years of community college free, paid for by the government. But at this point, Obama and his administration have not provided any ideas on how this is actually going to be paid for. Tonight, we might hear examples of how they might pay for this or how they plan to raise the money for it. You can imagine how expensive, especially with the rising cost of college tuition, how much this could really cost, no doubt in the billions and billions and billions of dollars. Just when we need a president or a leader who will call for sacrifice and say, listen, we cannot continue to provide more and more benefits to the American population, even though that would be nice, we don't have the money. Instead, they come up with these harebrained ideas that sound good on paper, but then they don't know how to pay for them, right? It's the same way with the wars. It's the same way with Obamacare. They just come up with these new ideas, which sound like a good idea at the time, but they never know how they're going to pay for them. They just borrow the money from the next generation. And this is really a very bad situation that we find ourselves in. And this is why I don't believe all the hype about the economy being better, because they are not solving the real fundamental and structural problems that we are facing and that our future generations are going to face. All right, with that said, let's bring on our good friend Tom Cloud for this week's Precious Metals Market Update.
Follow the Money Weekly presents your Precious Metals Market Update. Here's Tom Cloud.
Last week, we got hit with the news that the Swiss National Bank had decoupled the Swiss franc currency from the euro, and we immediately saw the currency go up over 20%, and it produced bankruptcies all over the place as we saw such storied banks as Citigroup and Barclays take losses of $150 and $50 million, and also the Deutsche Bank took a $50 million loss. One of the big ones was FXCM, which trades out of New York. They lost over $300 million by going the wrong way on the Swiss franc, and they were bailed out by Jefferies. And then the biggest loss came from Everest Capital Global Fund out of Miami, Florida, that lost over $830 million of clients' money by being on the wrong side of the trade. And as we talked about over the last several weeks, this is just the tip of the iceberg as we see both Portugal, Spain, Italy, Ireland, and Greece coming first, all looking at decoupling themselves from the euro and going out on their own in the world markets. And they certainly can't pull it off as we look at a country like Switzerland trying to get back and doing things right and becoming fiscal responsible. And this could later lead to gold being back, more gold backing the Swiss franc currency. So we now have an option, another currency to go to beside the dollar since the decoupling of that. And this will lead to more and more central banks as the week of January 19th wears on. We'll see more and more central banks. As I record this on Monday, we're in a national holiday, and we really expect by the time you see this on Tuesday, things will have already begun to move up again. So this is very important. But the other big breaking news came from Germany now going after repatriation of their debt, of their gold, and taking it back that has been primarily in the U.S. and some in London and some in France. And as we all know, as we've talked about in this show several times, we've only sent back a very small percentage of gold to Germany, and yet we are set to send back some 80 tons more, but we're still way behind the ball, and we'll not have all that sent back to them until 2020. But what is interesting is the Germans realize they're in the middle of this, and they're going to have a power play as we see other countries leave the euro. And even though Switzerland was not technically in the euro, they had their currency coupled to it and at a fixed rate of 1.20. Now we'll see other countries and other currencies, as I said, potentially and probably come out of it, which will put Germany in a place of either creating their own currency or going back to their own currency, or creating a currency with 4 or 5 other countries. Even the potential of the British coming back in after they've had the British pound here for several years on their own. So this could be a very important time coming up. And let me look at my notes, make sure we're not overlooking anything before I get into the actual gold and silver. But one thing people are figuring out, gold is for those prepared for what you don't see instead of what you see. But now you've got the advantage of waiting and seeing what a lot of us have seen for a long time, and a lot of us haven't. But now, with people like Mark Faber out this week, the guy from Hong Kong, a multi-billion-dollar asset manager, says that gold will go up at least 30% in 2015. We've seen numbers from as low as 15% to as high as 50% or more in gold. And we've even seen silver forecast as high as double, from $15.60 an ounce where it started the year up to over $31 by the end of the year. But what we do know right now, here we are on the 19th day of January, and gold is already up 8% for the year, with the stock market down 5% in 19 days. Silver's up 13.7%, and palladium is actually down 5% for the year, as there has been some concern with the events the past week leading to a deflation or potentially a world recession, not only in Europe and Japan, but other countries could also fall into a recession before there's enough money created out of thin air to send it the other way. So just we look at it as a great buy in palladium, and you're getting a 5% gift, in my opinion, because the reason it's backed up is because of the reason it won't happen. Because these countries, especially the ones that decouple from Europe, will print money and eventually have much higher inflation, and it won't take that long, especially in Greece, as we'll have the election soon and that coming. So we do know, we don't have to prepare for what we don't see anymore, but now we know with Obama getting ready to go on national TV and telling you hidden deep in the Obamacare, we're now looking at the new tax rates going up to 39.6%, and almost every tax rate going up 3 or 4%. And for those of us that own companies, we're going to go up 0.6% to match the FICA insurance, which is $600 for every $100,000 of payroll. So we know these taxes are coming. But the one that's really a game changer is the estate tax. We saw wealthy people like George Steinbrenner and many other very wealthy people die in the last 2 or 3 years and have over $1 billion estates with no estate tax. Now we're looking at Obama going on TV, and of course it does have to be voted on by the Senate and Congress, and we hope it won't pass, but he's going to push for it. And you realize if we go back to a $5 million, that over that 55% of over $5 million would go to the government in new estate taxes. And this has drastically affected the diamond market. I've never seen diamonds are out quicker this year than gold and silver. And that's something I'm happy to talk to you about if you have questions, but also gold and silver. A lot of people are going to move to have private investments that are liquid anywhere in the world, and gold and silver and diamonds are going to be the 3 leading candidates for that. And once again, you're going to see a lot of central bank purchases in the gold and silver market. So if any of you like to talk to me or Dan or Kathleen in my office, give us a call at 800-247-2888. 800-2812. Once again, that's 800-247-2812. And we'll be happy to discuss with you these precious metal market. And if you're looking for precious metals self-directed IRA, you can give us a call and we can help you set that up with one of the approved custodians and tell you how that works. But you can actually get in and own physical gold and silver. You can't take control of it, but you can own it and have it in your self-directed precious metals IRA. And for the ones that are still holding rare coins, we'd like to talk to you about that, because as I've said, if you look back at the Certified Coin Dealer Newsletters Index, rare coins are up like 80% over the last 14 years, and gold's gone from 250 to 1278 as I record this, for over 5 times, over 500% gain. So it's very important that you look out, and the collector market is diminishing, and more people are just moving into metals. And I deal with a lot of money managers, ones that manage from 10 million up to over 800 million. And the two largest I have moved to a larger percentage of metals already. So it's very important that you look at that and realize whatever allocation you have for gold and silver, you probably need to move it up. I'm happy to discuss that with you on a percentage of an overall portfolio and give you a range of what I see. I'm not a financial advisor, so I can only tell you what I'm seeing with other financial advisors that their clients buy physical gold and silver from us when they want it, instead of an ETF that you can't get the physical gold and silver in the ETF. So hopefully we can answer any questions. With this week's Precious Metals Market Update, this is Tom Cloud signing out.
Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812.
Are you prepared for the next stock market crash? It's not too late to protect yourself and your family with Jerry Robinson's best-selling book, Bankruptcy of Our Nation, now in a new audiobook format. Whether you want to listen in the car, at the gym, or on your iPad, we've got you covered. Get the entire 300-page book in audio format for only $24.95. That's over 12 hours of Jerry Robinson's economic wisdom, financial insights, and practical money-making strategies for only $24.95. Inside this new audiobook, you'll learn 21 profitable income streams you can create both now and in retirement, along with unique tips on how to inflation-proof your investment portfolio using our own PACE philosophy, and our 5 levels of financial freedom, which is Jerry Robinson's personal blueprint for building true wealth. If your goal is to become a better investor, increase your income, or just understand what is really happening in the global economy, you cannot afford to miss out on the vital information that is jam-packed into this 12-hour audio book. Get instant access to Bankruptcy of Our Nation in audio format right now by going online to www.ftmdaily.com/bankruptcy. That's ftmdaily.com/bankruptcy. Download your copy today and get on the fast track to true wealth and a lifetime of financial security.
Welcome back to Follow the Money Weekly. So glad that you're joining us. Well, earlier this week, I had a chance to be interviewed on the Financial Survival Network with Carrie Lutz. I'm going to play you a little clip of my time on there. We talked about real estate in particular, why I like rental real estate as a potential investment, especially now with mortgage rates being so low. And we also talked about the millennial generation, kind of an interesting discussion. It's about a 10-minute clip. Let's go ahead and roll the tape.
So what about mortgage rates? We going to see higher mortgage rates? Are we going to see interest rates head up? What's happening there?
Well, real estate has long been one of my favorite investment themes. Affordable housing, to me, is probably one of the best investments that I personally have ever found. I mean, some people might disagree with that, but for me, affordable housing, and the key word there is affordable. This is why if I lived in California, or if I lived in Florida, or if I lived in New York, there's some of these states that I probably couldn't say that about because it's hard to find affordable housing in those areas. But you come out to where I am in the middle of America. I've lived in Texas, Oklahoma, Arkansas, kind of in that range, Missouri. These are the Midwest is full of affordable housing. And so for that reason, I'm very bullish on affordable housing, no matter what happens to the economy, no matter what happens to the dollar, no matter what happens to our current system. People will always need to have a roof over their head. And as long as it's affordable, it'll be a necessity for them. And so I think this is probably, and this may sound absurd, but it's probably one of the better times to be investing in affordable housing because you can lock in these rates at such a low rate. It's also probably a very good time for people to consider refinancing. Although I'm not a financial advisor, they would want to talk to somebody about that first. But the rates right now are at a in fact, we haven't seen mortgage rates at their current levels in nearly 2 years. I wish that rates would have been where they are right now whenever I bought my latest property, which was about a year ago. Yeah, and I've seen rates fall, but we're also seeing a spike in mortgage applications. I mean, just last week alone, we saw a spike of about 49%, and that was pretty big. That was really big, and that's really driven by two things: A, these rates that are just continuing to fall, but B, the Obama administration has been pushing for more lax lending standards, which, you just got to laugh at that. I mean, it's insane that they keep doing the same thing over and over.
Our lesson.
Never learn. But there's a lot of people out there who are renters, and many of them are afraid to buy. Many of them don't want to buy, but some of them do, and they just can't achieve the rating or the special criteria that they have to meet. And so they're lowering those standards, dumbing down the standards, lowering the down payments and things of this nature. And I think we'll probably continue to see that until the feds are happy with the level of housing demand. And so I think right now is probably a really good time. In my area especially, there's a ton of houses that you can pick up very cheap and turn around and rent out to people who are willing to rent but not willing to buy. So as far as where they're going to go, nobody knows, but the mortgage rates right now are at a very low area. So it's either good for picking up new properties or refinancing existing mortgages.
Yeah, interesting. Yeah, I agree with you. Single family homes for rental.
Oh, gosh.
One of our sponsor, Jason Hartman at jasonhartman.com.
Mm-hmm. Sure.
The guy's been selling them off to people for years and years. And, you have the ability to refinance. You get positive cash flow. You don't want to buy them in, obviously, L.A. and New York City in that area because you'll never get a positive cash flow off of them. But he's talking about you buy them where you can rent them out for 1% of the purchase price.
There you go.
Per month.
That's it.
And at these rates, you have to make money on them. And, it's remarkable. I saw a room full of people who were happy investors. Some of them owned as many as 70 of them. And
I tell you, for the average family that's out there who are struggling to get by, I'll think about my own family. Whenever I was younger, my dad had a job and my mom had a job, and we still struggled. It was that kind of dual income and still having a hard time. Over the years since that time, I've seen people who've really succeeded. And one of the things that I think many people could do is just commit to buying 5 or 6 properties over the course of their working career, let renters pay them off,
over time.
Yeah.
And then when they reach retirement, not only do they have a 401k or an IRA or whatever they have, pension, whatever the case might be, but they also have these 5 paid off houses, that will pay them a cash flow for the rest of their life. And so many people miss out on that, I think. I love rental real estate.
Yeah. And
it's hard, though.
Yeah.
It's hard. It is hard. I got to admit, I've had some disastrous situations with rental real estate. So you got to walk into it with an iron gut. You got to be ready for and have a little bit of savings. But it's totally worth it if you can handle it.
Well, now, look, you got databases, so you can weed out probably 95% of your problem tenants. You can get rid of them. Just using Google, you can get rid of most of them. And look, you can, property management easier than it's been in the past. Valuations are easier because, especially in Florida here, Jerry, every single piece of information that you want is open on the internet. So, in terms of that, buying in foreclosure, easier than ever. You can buy in Florida online foreclosure sales. There's hundreds, if not thousands a week. And, and then, as far as if you need to get mortgages on them, that's easier than ever. So,
I'm just sitting here looking at some information about the rising rental costs in Florida. I'm looking at Palm Beach in particular.
My county, that's where I live.
Your backyard there. The effective rents in the fourth quarter alone, just in 2014, they went up 4.3%. So the rents went up 4.3%. Miami went up 6%.
Oh, forget Miami. That's a
then
good
you,
one.
Then you have
Slums
places
are doubling in price. You can't even believe it. Places that are unsafe to walk down the street doubled last year in price.
Isn't that something? And then out in California, like Oakland's up 7.5%. San Jose is up like 9%. Denver, scratching my head here, up 8%. I can't imagine what's changed out in Denver, why people will want to buy out
there.
there.
Marijuana trade. That's all I can figure.
But
what are you going to do?
But rents are going up. I mean, they are going up. And the reason is because we're turning into a renter nation. Just...
And it's going to get worse because
it's going to get worse and worse.
Millennials are not buyers; they're renters. They don't have that American dream thing in their mind. And another one of my sponsors has bought hundreds of foreclosures down here in Southwest Florida. Teaches people how to do it. It's so simple you can't even believe it. With the online foreclosure sales, it's like eBay, Jerry. I mean, it's so easy to do wherever you are in the country. You just can't even believe it.
Every week or so, we'll get a couple of emails, Carrie, from somebody who's young, like one of these millennials, and they'll say, I really appreciate the site, appreciate the show, but what can I do? I don't have a college degree. I don't, I'm just getting started. What would you recommend to me? And I always tell them the same thing, and maybe I need to edit this, but I'll tell you what I usually tell them. Everything that I see from millennials, and I'm not putting them down as a generation, I'm making an observation. They don't know how to fix anything. This is part of the reason why they become renters, is because if they bought a home, how are they going to fix everything? They're going to have to, of course, hire everything out. So in many ways, they just expect things to work. And therefore,
you're describing my kids, two girls, not to be typical, but even my son, I mean, I know how to fix things. My father was a builder. I was just mechanically inclined,
it's hard to blame them because they grew up with, tablets and screens and
throwaway society
and a disposable kind of economy. Yeah. So I get that. But I tell you, for these younger guys that are getting out, I know this doesn't sound great because you want to work in a nice cushy job and sit in the office and get air conditioning and artificial light, and you want Facebook on your screen and everything while you're working. Yeah. I realize that's what most people think they want, but those are the Joneses, and the Joneses are broke. And so if you really want to get ahead, here's what you can do. You can learn how to fix things. Yeah. One of the first things I did whenever I got out of high school was my father taught me how to fix appliances. I can always fall back on that no matter what happens in any town. Learn to fix cars, learn to fix things that your generation will have to pay to have fixed because they don't want to learn how to fix them. So that's one of the biggest things. I hear people talk about coding and computer computer coding too. That's a really powerful one as well. But if you learn how to fix things, learn how to fix plumbing or electrical work, gosh, I've talked to so many guys who are older, that gray hair generation, that greatest generation who are dying out now. And they're saying there's just not enough plumbers. There's not enough electricians to fill our shoes.
Masons is one.
We're losing.
So many South Americans are in construction trades now because they know how to pile up bricks and blocks and cement them together.
These salts of the earth kind of people, and they're just kind of dying off. And then you have a new generation who's not replacing them. So it's quite lucrative to learn, to learn a skill like that today.
Huge.
Yeah.
So
and it would help with your real estate. So it kind of goes hand in hand.
Oh yeah, if you can fix it, definitely a plus to do on your own.
And now, here with this week's Investing Insight is our good friend Tommy Cloud Jr. from 11-2 Fund Management.
Well, here we are still at the beginning of the year, and maybe it's time for us to continue to review our New Year's resolutions, if people do that type of thing. I'm always a big proponent of, if you see that you need to change something in your life, don't wait another day to start praying about how you can change it or how God can change it in your life. I'm here on the Dave Ramsey website, and I'm looking at the 20 things the rich do every day. And number 11 on this list says 6% of wealthy say what's on their mind versus 69% of the poor. So this is a very low percentage of wealthy people that actually say what they're thinking versus the poor that just say whatever they're thinking. Does the Bible confirm this behavior of the rich people as something that is righteous, or is this something that rich people are doing that's not a good idea? Proverbs 29:11, a fool gives full vent to his anger, but a wise man holds it in check. So certainly the Word of God does confirm this particular habit of the rich people. So maybe in 2015, if we really want to have more money to follow daily, we should be able to hold back our anger and keep it in check rather than giving full vent to it. We also, this past 12 months in the peer-to-peer lending that I'm managing for my clients, we saw a return of around 5.3%. That is after all fees and net to the client. So that's been a great income stream for some of the 11-2 Fund Management clients. And if you would like to learn more about that, you may reach me at 1-800-917-5016. That is it from Tommy Cloud of 11-2 Fund Management this week. Thanks, Jerry.
All right, friends, well, that brings us to the end of our program. Thank you so much for choosing to allow us into your life each and every week right here on this program. And as always, I leave you with this final word, this time spoken by Martin Luther King Jr. when he said, "Darkness cannot drive out darkness. Only light can do that. Hate cannot drive out hate. Only love can do that." This week, we salute and honor Martin Luther King Jr., who would have been 86 years old this month. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next Tuesday. Until then, God bless.
All of the information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud and Thomas Cloud Jr., are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Thomas Cloud Jr. owns 11-2 Fund Management Incorporated, a registered investment advisor. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult